Yeah, today we're going to focus on kind of tax deductions that you can take both on an S Corp and a C Corp, just to make sure you're getting all the deductions you and benefits you can have to lower your taxable income. And then based on some feedback, we'll kind of discuss a little difference between the S Corp and the C Corp as well. So to start off, whether you're a sole proprietor and you don't have an LLC or you do have an LLC, you would use a Schedule C. And with an S Corp, you don't file that on your personal return. You will file that through an 1120S, which is a different tax form. And then that will issue a K1 that goes on to your personal return. So there's like the two differences right there. Both S Corps and C Corps, you will have to pay that 15.3% self-employment tax, half for the employer, half for the employee. One of the positive notes is, though, you are able to, on the sole proprietor, you are able to deduct half of that as a cost. So you pay the 15.3% out. You do get a credit of 7.65% to help offset your income. So on the sole proprietor, that is helpful because it does lower some of your tax burden. So that's for the C Corp. On the S Corp, what's nice about it, and that was mentioned earlier by Chris, and we'll do a presentation on when to go from a sole proprietor LLC to be elected to be taxed as an S Corp. Because what's nice about an S Corp is you do get issued a W-2 through the S Corp because it's a corporation. So you're still really paying that 7.65%. You've got the employee portion, the employer portion, but your W-2 wage, you can find a reasonable wage, out there on Indeed that might be significantly lower than what you're making as a sole proprietor. So let's say you're making $100,000 as a sole proprietor, you're gonna have to pay 15% self-employment tax on that entire amount. Well, if you run it through an S Corp, let's say you find a similar job duty that's paying you $40,000. Well, you pay that 15% on that $40,000. That remaining $60,000 then gets paid year-end or quarterly as a distribution. So you get to avoid 15% on the self-employment tax on that portion. So again, we'll do a presentation later on this year about when to try to elect an S Corp. It's going to be different for every person, but that is kind of one of the major benefits is you don't have to take your entire wage as an S Corp, which allows you to avoid that self-employment tax of 15.3%. So that's one big difference. Another difference between the S Corp and a C Corp is the home office deduction. So if I'm a sole proprietor and I'm filling out my Schedule C, I'm able to deduct my home office. A lot of people are interested in deducting their home office. And there's a couple of ways you can deduct your home office. They have a standard method, which is about $5 per square foot, up to 300 square feet. So right off the top, through your Schedule C, you could lower your income by about $5 a square foot up to $1,500 if you decide to do the standard deduction. Or and I won't go too more in depth on this to keep it high level because this could take a whole half hour to hour to explain. But then there's also like the actual expense of the home office where you take the proportion of the square footage of your office over your entire home. So if you had 100 square foot office that was dedicated space in your home and you had a 1,000 square foot apartment, 10% of the costs would be your ratio that you could expense as home office. So rent, mortgage, insurance, utilities, and so forth, and depreciation. So that you can deduct on a Schedule C, but not really at an S Corp as much. And another similarity between those are kind of the two big differences between the two right now. And again, depending on what route you want to choose, really is kind of a scenario you'd have to sit with your CPA or financial planner to kind of determine when it's correct to elect the right option to go to a C Corp, or also whether to take the standard or the actual home office. Usually the actual home office gives you a higher deduction, which is going to lower your taxable income. One thing though that you can deduct on both is health insurance premiums. So if you're a sole proprietor and your wife or spouse or husband, if they do not have health insurance through their job, you can write off your health insurance, their health insurance, and your kids, if you have kids' health insurance, as long as they're not 27, you can expense that all through your sole proprietorship and LLC. As well, on the S Corp, you can expense your health insurance premiums. So, these are just ways to make sure if you are in any one of these situations that you're getting those deductions, because you're already paying them, and let's reflect that on your tax return and as expenses, so we can lower your taxes. Another thing you can deduct on both is meals. Every dollar you spend on meals that's business related, historically it's been 50% that you're able to deduct. Under the new CAA, the Consolidated Appropriations Act, you're actually going to be able to deduct 100% of your business meals, starting January 1st, 21 through the end of 22 of this year. So instead of getting that half, you'll be able to deduct 100% for this year and last year. So far, I kind of threw a lot out. Any questions on just those main items?